The synthesis of modern financial theory reveals a profound tension between the mathematical perfection of competitive markets and the biological imperfection of the human agents who operate within them. Throughout this video, I will explain the main views on multi-portfolio theory and in the end try to answer the question: is it possible to beat the market? The formalizations of efficient markets came in 1970s under some papers from Fama. In his landmark review, Efficient Capital Markets established the bedrock of modern finance by categorizing the efficient market hypothesis, or EMH. Efficient meaning that there's no excess return over risk taken, so every past performance is explained exactly in consideration of the risk you have taken. Risk was defined in its primary form as volatility and later augmented to market capitalization and price to book or earnings. Therefore, if you had high returns in the past, it means generally that you invested into low price to book, low price to earnings, small cap volatile stocks. And if your performance was poor, it was mainly caused by staying invested into large cap, highest price to book, low beta companies. He then added a layer to approximate how efficient markets are. Fama established 3 levels of information integration that, under each investor assumption, determine indeed how much the markets react to data. Those were weak, semi-strong, and strong. In the weak form, asset prices already incorporated all past trading information, such as historical prices and volumes, so technical analysis cannot systematically generate abnormal returns. This today is generally accepted among investors. We assume that there's no such a thing as charting resistance and bottoms, and that even though they exist out there, due to advances in technology and machine learning, there's no way to humanly compete to intricate computers designed to recognize patterns and arbitrage them. What this still allows is fundamental analysis, so we could still identify undervalued companies based on margins, earnings, and growth, and buy them below their intrinsic value, or sell them when they are overvalued. In this semi-strong form, prices reflect all publicly available information, including financial statements, news, and macroeconomic data, signifying that neither technical nor fundamental analysis can consistently outperform the market, because new information is rapidly incorporated into prices. Every new quarter or annual statement, 10Q or 10K, is rapidly plotted into appraising models, adjusting their valuation instantly. So every stock price is already incorporating all of the analysis underneath the company, and buying one of the other will just be a trade-off between risk and return that will not generate extra benefits. Remember, extra meaning that there's no alpha. You get what you pay. If you invested into travel companies and one of them outperforms, you had the returns according to the risk you have taken. Finally, in the strong form, prices reflect all information, both public and private, implying that even insiders with non-public data cannot systematically earn abnormal returns. Under this assumption, prices will correct even before the fact is announced, due to insider leakage or abnormal power of common sense in the market that will ex ante analyze the situation and come to a conclusion that will be the actual resolution. For instance, if there's a failure in a railroad and 3 businesses are threatened with charges, the market will already know which one will be sued, ergo its price will fall the most. While Fama addressed how information moves, William F. Sharpe in his 1991 The Arithmetic of Active Management paper addressed how capital moves. Sharpe's formalized a logical tautology. Before expenses, the return on the average actively managed dollar must equal the return on the average passively managed dollar. However, because active management incurs higher turnover, research, and administrative expenses, the aggregate active return after cost must be lower than the passive benchmark. This cost matter hypothesis transforms the market into a zero-sum game before fees and a negative-sum game after fees. But what does all of this mean? Well, simply that if the average return on the market is 10%, then the average fund manager will make 10%. But since they do not do it for free, your returns are always going to be lower. And this is the catch, proportionally to the fee. If the expenses are 2% and average market yield is 10%, then you'll get on average 8%. This is empirically validated by SPIVA scorecards, a basic measure for manager performance against a passive index, which consistently shows that a vast majority of US equity funds underperform over 5, 10, and 15-year horizons. Furthermore, Berk and Green in 2004 introduced a rational explanation for the lack of persistence. Capital is competitive. When a manager demonstrates skill, massive capital inflows occur until the fund reaches a size where the trading costs and administrative friction eliminate the scalable alpha, being faced with diminishing returns. Thus, even in a war with adroit individuals, the market could remain efficient at the aggregate level because of supply and demand. The best ones will receive more funds, have lower performance because of missing opportunities, and vice versa. Now, let's switch towards the other perspective. What I'm mainly been displaying here is a depiction of a perfect or quasi-perfect market that has exceptional rational agents that can identify mispricing and arbitrage opportunities immediately. What if we are not that optimizers and have some erratic behavior and buy the hot stock that's in everybody's mouth and sell when everybody is depressed and fearful? Those are the roots of what's called behavioral finance. Contradicting the irrational agent model is prospect theory, pioneered by Kahneman and Tversky. They observed that humans possess an asymmetric utility function. They are roughly twice as sensitive to losses as we are to gains, what's called loss aversion. A way to think about it is imagine a bet in which we either win or lose $100 with 50% probability. For the majority of citizenry, the loss in utility caused in the negative event does not compensate for the reward or happiness obtained in the good scenario. This is manifested in a variety of signals, as could be the disposition effect, where investors prematurely realize gains to protect them but delay realizing losses in hopes of recovery, forgetting that stocks doesn't know you own them and that the price you pay has nothing to do with the current price and intrinsic value. Such behavior results in suboptimal tax timing and portfolio drift. The other ways in which behavioral effect is captured is in excessive risk aversion after downturns. After losing money, investors become overly conservative and they may miss future rebounds or avoid equities entirely, leading them to underperform. This could also be displayed in preference for safe but suboptimal assets, overweighting cash, bonds, or guaranteed products, even when long-term expected returns are lower. Overreaction to short-term volatility, leading to higher fees and time in the market. A heuristic caused to over-extrapolate the recent performance, leading to chase the last best or worst stock, thinking that either if it's been growing, it will keep doing so, or how much lower can it get. This should be the bottom, right? Aside from these psychological studies, Robert Shiller's work on irrational exuberance highlights that markets are social systems prone to feedback loops. Shiller's demonstrated that stock price volatility is far too high to be explained by changes in discounted future dividends alone. Instead, prices are driven by narrative economics, which are socially transmitted stories that create speculative bumps and busts. The cycles generated as FOMO, or fear of missing out, is created around a stock. It outperforms from a brief span, investors push valuations too high, and remember, every time the price of a company goes up, it actually decreases the yield on investment. Think of a commercial property. If the rent is fixed, let's say at $100, it would be better to pay $1,000 rather than $2,000 for it. Of course, the only rational reason why investors would overweight a firm is primarily by an increase in growth. During peaks, expectations travel faster than earnings growth. The stock has been overbought by even leveraged traders. At this point, a reversal in market expectations causes a downturn which gets accentuated by fear and debt, causing a bust. So under Bob Shiller's view, the market will always be a pendulum, swinging between fear and greed, pretty much fun to value investors such as Warren Buffett or Benjamin Graham. So, is it possible to beat the market? under the Homo economicus and efficient market hypothesis? No, as investors already incorporated all information available and an alternative view is simply inexistent. Kahneman and Tversky? The answer is still no. Even if you were able to identify mispricing and detect undervalued equities, you will not be strong-minded enough to buy and sell profitably. Dan, Shiller, Graham, and Buffett. They still think that markets act irrational. It's just a matter of isolating public opinion, appraising businesses correctly, and avoid media influence. Of course, easier said than done. The modern market is an environment where short-term mispricing is frequent due to human psychology, but exploiting these signals requires a time horizon and tolerance for tracking error that few participants, constrained by career risk and benchmark pressure, can actually maintain. But I'll give you my take on this. Can you beat the market? Is not the right question. I thought for this a lot while reading The Intelligent Investor. In the end, the important thing is not to outperform, but simply perform. I would not be satisfied if the market is 20% down and I'm only 5 in the red, nor I would care much if my average CAGR is 7% instead of 9% for the market, as long as the money I generated is enough to supply my requirements. I personally love investigating corporations, understanding their businesses, and buying their stock. Although I strongly consider having a portion of your savings in index funds, as they are astonishingly simple and have delivered incredible results. Well, that's it for today. I appreciate you watching the entire video. If you like it, subscribe and hit the like button. If you did not enjoy it, please tell me in the comments why so I could fix it for the upcoming videos. My name is Fausto Catalano and I'll see you soon.